Dornbush download number 155. How you going, Michael?
Yeah, good, Dan. How about yourself?
Good.
Just a few little local gags here, just as we're starting off.
Getting underway. Can't be too serious, can we, on Wednesday?
If you couldn't laugh about these things, you'd cry a lot of the time in this game. That's for sure. But I guess interest rates, Dan, are on the talking list, I suppose, at the moment. And US Federal Reserve is talking interest rates. What are we expecting out of there?
Well, I don't think we'll expect much initially, but rates, I think, certainly are going up. I see a report today that a couple of the houses are calling for interest rates to start to go up in Australia in 2018 as well. So who knows?
Yeah. No, certainly the US has been in that interest rate rising cycle, hasn't it? I think the last 3 meetings has basically been an interest rate rise for the US Federal Reserve. But yeah, you're exactly right. I think the last probability of the latest calculation of probability for an interest rate rise in America was something like 1.5%. So
pretty low.
98.5% are suggesting that rates will stay on hold over there for this meeting at least. But certainly there is an upward pressure on interest rates.
Well, they're talking this meeting, aren't they, about unwinding some of that debt, and part of that's rising interest rates, isn't it? So it's going to be interesting to see where they go there.
Yeah, very true, Dan. I mean, we had the 3 rounds of quantitative easing, which, I guess looking back over our shoulder, probably saved the US economy in a lot of respects. But I think they've amassed something like $4.5 trillion worth of bonds, predominantly
Just so quick.
Yeah, 4.5 trillion. Predominantly treasuries and mortgage-backed securities. So, they've got a bucket load of these things. And as you say, I mean, it's not as if they can just snap their fingers and start offloading this stuff. It'll be a slow, measured, process.
Yeah.
Potentially,
and then Europe's after that, isn't it?
Yeah,
they're up there as well. So.
Absolutely, potentially 5 or 6 years in the making. Getting back to sort of more regulated levels. But yeah, that'll be certainly something of great interest tonight. Whether Janet Yellen comes out and suggests that big bond sell down will start to happen.
Yeah. From our market perspective, I suppose those rising interest rates are positive for banks. Not so positive for those companies with a lot of debt, like Sydney Airports, Transurban. Maybe not so positives for companies with high price earnings ratios. And there's a lot of those out there, Michael, isn't there? I was looking at Link Market Services yesterday. They're up at around the 20 odd times. The Australian Stock Exchange is up there. Some of those food companies, I know Domino's is right up there as well, aren't they? So time to maybe take a bit of stock with those companies that are carrying a lot of debt, do have high price earnings ratios, have a bit of a review of the portfolios.
No, definitely, Dan. It's a good point you bring up. I mean, Sydney Airports, Transurban, Australian Pipeline,
APA,
they're all sort of, I guess, quasi-interest rate securities in their own right, aren't they? And they often have an inverse relationship with interest rates. So if there is upward pressure here on interest rates, then those guys, could certainly see a little bit of pressure on share prices. The Reserve Bank brought out their minutes yesterday, and again seems like it's pretty much steady as she goes. They're very comfortable with the labour market at the moment, albeit they don't see great sort of wage growth or employment growth anytime soon. But interestingly, the exchange rates come back up on the radar for the Reserve Bank again.
With our exports.
Absolutely.
It's not one thing, it's the other, isn't it? It's a vicious cycle.
It just ebbs and flows, doesn't it? So, but the Reserve Bank's always been, quite adamant and keen to keep that exchange rate down in the low 70s.
Yep.
I think we're up at around about the 80% mark now at the moment. So Reserve Bank, as always,
a bit of work to do.
Have something to keep an eye on. So, I guess finally, Dan, bit of reporting season 2 on the banking sector front. Bank of Queensland reports on the 12th of October, so that'll start the next cycle with Westpac, ANZ, NAB, not long after that. So I know that you've done it in the past, and there's a little bit of buying sort of 45 days into those reports for dividends.
Well, seasonally the banks sort of pick up last week in September, early October. So yeah, and that's probably around that 45-day rule. Just on price earnings ratios, you know, they're all bar the Bank of Queensland at around that 13 times as well. So you know, it's sort of on the money for buying banks, isn't it?
Yeah, it is, Dan. No, they're not super cheap, but they're not super sort of expensive either.
Yeah.
They're reasonable buying, and certainly if you can squeeze a 6% fully franked dividend out of them, it's not a bad prospect.
Better than term deposits.
Yeah, absolutely. I think
Again.
I think that's about us done, Dan. Yeah.
Thanks.
Thanks for watching.